Ladies and gentlemen, welcome to What Are Your Thoughts? A production of The Compound here on the Compound YouTube channel and podcast platforms everywhere. My name is Downtown Josh Brown. In case this is your first time watching and or listening, and I'm here with my co-host, as always, Mr. Michael Batnick. Michael, say hello.
Hello, ladies and gentlemen.
All right, tonight's sponsor, YCharts. YCharts, if you're already taking advantage of all the free content YCharts puts out, you're definitely going to want to check out their LinkedIn newsletter. What else should we say about this, Michael?
I use YCharts all day, every day, including Sunday. Sunday night, what's going on with this carry trade blow-up that we're going to talk about? Let me check the yen strengthening. Boom! Punch it up on YCharts. It's there. Everything's there. Everything you need, economic data, stock market data, index, ETF, model portfolios, whatever you need, they've got you covered.
Yeah, and if you're an advisor, check out YCharts Advisor Pulse. Gives you direct access to crucial market and economic trends, actionable insights you could share with your clients, and a lot more. Remember, you get 20% off your initial YCharts professional subscription when you start your trial and tell them the Compound sent you. So go to ycharts.com for more. Okay. The big question this week in the markets, Michael, is it too late? Did the Fed already wait too long? Is the error unfixable? Like what do we do now?
Nothing is fucked, dude. You're being very undude. No, it's not too late. I don't think it's too late.
Are you sure?
No.
Are you sure?
No, I'm not.
Okay.
I'm not sure.
But if you had to say a percentage of confidence that it's not too late.
These are odds, my friend. They're odds. So we could say two things. Number one, you and I both agree that they should have went in July. But by the time of the next meeting, and assume they cut in September, will everything have come unraveled? No, I don't think so. So is it too late? Like, I would say no, minus 115, minus 120. So not a table pounding, not an emphatic no, it's not too late, but nevertheless, no, it's not too late.
Things have been set in motion that cannot be stopped.
Go on.
The Somme rule has been triggered. I'm just saying it has. In my experience, I don't have much more experience than you do, but once the unemployment rate starts to get going, it's really tough to reverse it without it going too far. So far, by the way, this is like a little bit early on this because we're still adding jobs each month. It's just that the data is now disappointing. It's the downside.
So
and,
to the point about
I've never seen them come to the rescue in time. So
there's so much weird shit going on in the economy as we unwind from the effects of COVID. Kevin Gordon from Schwab tweeted a chart that shows there have never been 4 months where the unemployment rate rose for 4 consecutive months without it triggering a recession. That's never happened before. Could happen this time. But the reason why I say it's not too late is because, usually when unemployment starts going up, it doesn't stop or slow down. But things are still very, very unusual in this economy. And I think that a lot of things that are like set in stone type economic laws, throw them out the window. It's not a reliable playbook.
That's the good news. And this is the point so we had Claudia Somme on the YouTube channel last night, and she basically said one of the problems with using this trigger for the Somme rule, meaning we're 0.5 percentage point above the lowest 3-month average of the last 12 months for unemployment, is that the labor force is growing. So more workers, because we've had a resumption in immigration, which immigration was effectively shut off for the 2 years during COVID. Now that there's immigration again and other things, the labor force is growing again, which means the denominator that we get the unemployment rate from is changing. So it's not like a hard and fast, that's it, we're at 4.53%. That means, it triggers a recession. So she's not so sure that her rule will work as it's worked since she started to document it using the 1970s and forward. This time could actually be different, and that's coming from the horse's mouth.
Here's what we know. Right. Cam Harvey was saying something similar. Like, people that invent the rule, No.
Cam Harvey said it's a done deal.
No. My point is when the yield curve inverted, similarly, he said, listen, this worked in the past, but things are very odd right now. So rules that have worked that you could like take to the bank might not be so today. Here's what we know. We know that the Fed will cut rates, right? Right?
Yeah.
Yeah, we do know that. So it's coming in a month. We don't know how many cuts. We don't know how big the cuts will be, but we know we can prepare for cuts. We also know what we're hearing from corporate America. And it's mixed. It's not amazing. Things are slowing down a little bit, moderating, normalized, whatever you want to say. It's not gangbusters, but is anybody saying like, this is an emergency, we are completely screwed? If you look at the real-time data, it's fine. It really is fine. So no, I don't think it's too late.
I listened to Dara on the Uber call this morning, and his comment was, look, we obviously service the high end. Like his consumer is not the consumer that's shopping at Five Below. If you're buying food on Uber Eats, it's $30. If you're taking an Uber instead of a bus to get somewhere, you're the high end consumer. He said there's absolutely no sign of a slowdown anywhere. Beat on earnings, beat on revenue, gave great guidance, and they're just not seeing it in the data. They're not even really talking about trade downs or anything like that. So
do you think it's too,
it'll stay that way.
Do you think it's too late?
I want to read. Well, I'm not sure how I feel. I want to read you something that Cam Harvey wrote. This seems so. Cam Harvey is the father of the yield curve indicator, friend of the show. He's been on. He's in the too late camp, and the yield curve has now been inverted for 20 months. And I want to read to you what he said. Quote: "It has begun. Over the last year, I have made the strongest possible case for the Fed to be proactive. Rates should have been cut this week. Indeed, the rates should have been cut in January. We have seen this movie before. The Fed was late to take inflation seriously in 21. They brushed it off as transitory. However, it seemed obvious that inflation was surging. Real-time shelter inflation was increasing at a double-digit rate. Shelter has the highest weight in the CPI. Shelter operates with a lag. Hence, it was easy to forecast the surge. The Fed was forced to react after the damage was done." So, Michael, what he's saying is that we're doing the same thing all over again. The same mistake has been repeated despite many warnings. The CPI print was 3% year over year, but 2/3 of it was driven by one component, shelter. And we know the shelter data the Fed is using is like a year out of date. If you were to have been using real-time shelter data, you already would have been cutting earlier this year. And please, let's put this chart up, John. COVID-era savings have been depleted as credit card delinquencies reach new highs. Here it is. So this is the thing that we said, let's keep an eye on it. Let's keep an eye on it. And here it is. So you've got a consumer that's basically done with the post-pandemic spending splurge. They have run through those savings. And now, we just heard from the financials, they're not panicking, but they're reserving more money, and they see delinquent bills beginning to pile up. So these two things are happening in confirmation of a softening labor market. And so Cam's in the too late camp.
So they were too late to hike, and they are too late to cut, but those two things are not the same. It's not symmetrical, because they were too late to respond to inflation, which was surging. And on the other side of it, things are cooling, normalizing. It's not like the wheels are falling off. So it's not exactly the same thing. I think the danger of being a little bit late is not the same thing.
Respectfully, it's not the same thing if you're talking about corporate borrowing and balance sheets, but we're not. If you're talking about consumers and small business owners and the people that corporations need to keep spending, it is the same thing. And the Fed made this mistake in 2007. I don't think they cut until October, when it was clear all year that they were too tight. And guess where they were? 5.25 on Fed funds rate. And they stayed there, and they stayed there, and they stayed there, and they wanted to wait, and they wanted to wait. And then when the hedge funds and the banks started to blow up, then they started to cut. But it was too late. It was things had been set into motion.
We know how fast narratives change. And if come September, the S&P is near all-time highs, and the Fed cuts then, all this will be forgotten.
I'm not. Again, you're having an S&P conversation, and I'm having an economy conversation, and the two things are related but not the same. And they certainly don't move on the same timeline.
Fine, fair. But even looking at the economy, yeah, things are not as strong as they were a couple of months ago. There's no doubt about that. I just don't know that this needs to. I just don't think that the wheels need to come off. I don't think it needs to get that bad.
No, nothing needs to happen. I wouldn't look. Cam is like, this is done. This is guaranteed. I'm not saying that. I'm repeating what he's saying. I'm just saying it's unfortunate that we had to go this far, and we had to blow through so many obvious opportunities.
Let me ask you this:
to change the situation
for the real economy, forget about the stock market. Does it matter if they cut in August or July or September?
No, they probably should have already started cutting. July is probably, in other words, we know that these things operate on a lag. So July might have also been too late.
Right.
So if you listen to people like Cam, you listen to Neil Dutta, people that we read and we respect, and who are not just noisemakers for the sake of getting attention, but really believe the words that they're saying. If the Fed needs to be more proactive, it needs to stop with the data dependent. If the data it's looking at is operating on such a lag that it renders monetary policy less effective.
So I think we agree. We both think that the Fed should have cut in July, or maybe we don't agree. I don't necessarily think that it means that the economy is going to materially soften. It might or might not. I don't know. We'll find out.
Well, if you have 2% and change percent GDP growth, if you're lucky, and inflation is like 2.5% on PCE, why are you at 5.25%? And a better question, and Neil Dutta has asked this question. Okay, let's assume that the Fed wants to be data dependent. Can you even come up with a mechanism whereby inflation accelerates from here? How would that happen? What would make that happen? Why would it happen? We're saying the labor force is growing and the pace of hiring is slowing. By what? And shelter prices broke 2 months ago.
Everything's cooling.
But so, like, by what metric is it too early to cut rates? How do you envision inflation reaccelerating to the upside? What would be the thing that causes it? Nobody's come up with that answer.
What do you think about the calls yesterday for an emergency rate cut?
I was sad to see. I saw the clip of Professor Siegel screaming for a 75 basis point cut. Again, we know that these things operate on a lag, so I don't even know what that would do.
I actually think that might have caused panic had they come out and done that.
I was sad to see that. I wish he had. Look, he's another person who's been saying the Fed is too tight. If you look at shelter data, that's like not from the Stone Age. You know, so I think he's been right. I don't think it helps to go on TV and scream like that, at least at this point. We have traders now betting on a high probability of an intra-meeting cut. I would take the other side of that. What are the odds?
Where are you seeing this? 60. Where does that even show up?
This is a Bloomberg article yesterday. Bond traders are piling into bets that the U.S. economy is on the verge of deteriorating so quickly that the Federal Reserve will need to start easing monetary policy aggressively, potentially before the next scheduled meeting. No way. Traders now see a roughly 60% chance of an emergency quarter-point cut within 1 week.
Well, 60% of the time, it works every time. I don't know about that.
That's a lot.
Here's Yardeni. He said, we don't think the Fed will be that responsive to this pullback unless a global credit crunch results from the yen carry trade unwind. We are sticking with just one cut in September for the rest of the year. No recession, no bear market. This too shall pass.
Peter Bookvar said, the only reason I keep hearing people cry for an intermeeting Fed rate cut is because the Fed over the past few decades has bailed out markets so many times. People have been trained all too well to expect it. Dallas Fed President Richard Fisher yesterday, quote, the Fed will always act as if something occurs that threatens the credit system or the economy, and it is not yet clear what has happened in the last few days, including with the Dow off over 1,000, is going to threaten the economy or the credit system. I think that's right. I don't know. Maybe somebody else sees something that I don't see, but
so the economy's softening and the yen carry trade unwind are different things, right? They're different things. They happen simultaneously.
They're happening at the same time,
which is not great. But the yen carry trade, which we're going to talk about later, seemed like that was a market event. What does that have to do with the real economy?
Well, they're not unrelated, part of the reason why the carry trade blows up is the Fed cuts while Japan is raising.
I understand. But for like actual, for hiring and things like that.
Look, I think you had 4 things happen all at the same time that are somewhat related, but not definitely related. And they all contributed to the Sunday scaries. To
So
the futures
yen.
doing AI earnings disappointing, which you had Microsoft and Amazon both disappoint on cloud. NVIDIA came out and said the Blackwell chip is going to be delayed. Okay. That's an AI-related disappointment, and those stocks are really important to the market.
Buffett.
2, the yen carry trade unraveling and the Nikkei having its biggest one-day drop since 1987. 3, Warren Buffett cut his Apple position in half, very unexpectedly. And then 4, an unemployment report that is now bad news is bad news.
Yeah.
Those 4 things were an insurmountable challenge to the sentiment, and everything just broke at the same time. That's it.
Guess
I mean,
what?
It's not that complex.
If this is how the fever breaks, I'd rather this than the something else happening, like Apple like bombing their earnings, which is not what happened. So this is an okay sell-off.
So now now you have, it's August 6th today. It's actually my mom's birthday. I got to send a text.
Happy birthday.
It's August 6th today. Now you're in a situation where you have basically 6 weeks until the September Fed meeting. They can do a lot of signaling at Jackson Hole, which I'm sure they will, to maybe try to calm people down. But it's a lot of time. And Bank of America took a look at the probability of there being an intermeeting cut. And Michael Gapin, the U.S. economist at B of A, basically says no way. We quote, we count 9 emergency rate cuts if we include the response to the Black Monday stock market crash in 1987, when the funds rate was not the principal tool of policy. Intermeeting cuts are truly emergency-based actions. The evidence in each of these, they reviewed each of the 9 cases, Michael, in which the Fed did something intermeeting. Each of these cases comes amidst truly emergency conditions in the economy or financial markets, global pandemics, the bursting of asset price bubbles, systemic events with sizable spillovers like the GFC, LTCM, Russian financial crisis, acts of war like 9/11. There's just none of that going on right now.
Yeah, hedge funds blowing up is not reason to emergency
unless
cut.
they're going to take the whole market down with them repeatedly. That's exactly
which
right.
Thank God it's early, but it doesn't appear that to be like that's the case.
Even a stock market fall, Gapin points out, the S&P 500 fell by only 15% after the 9/11 attacks, but the economy had already lost jobs for 8 consecutive months. Only 2 weeks before the 9/11 attacks, non-farm payrolls fell by 259,000, which we're obviously not seeing. So you had an intermeeting cut after 9/11, and the stock market was down by 15%. But the context was we were already deep in a recession with huge job losses. So
Are
like
you hearing
that,
anybody say that we're in a recession now? No, right?
No, what people are saying is it's too late. The trigger has gone off, and it's not going to turn back the other way. And to their point, these things do have a momentum to them. Economic data in the short term oscillates, but in the long term, it does trend. Especially things like employment, because it's a psychology thing. So, can you think of a lot of CFOs right now who are like, you know what? Let's do a whole bunch of hiring. Like, everyone is in this mode of how can we get by with less, and eventually it spills over. So, like, I feel like I don't think it's too late, but it didn't need to get to this point where we even think it might be. We had the soft landing. Like, we threaded the needle. Why are we first doing the first rate hike with economic data repeatedly surprising to the downside? It just doesn't make sense to me that the Fed needs to be that reactive.
Yeah.
But anyway, I think we beat this to death.
Okay, so I was going to talk before we had the yen implosion, just like how it's so interesting how quickly the narrative changes from Mag 7, the only growth in town, and then for reasons that are, you can come up with reasons, but we saw the stocks that have been left for dead start to outperform. Like the equally we were talking a lot about just was really outperforming. And so looking at the highest alpha for beats, this is from Bank of America, since Q4 2018, we're looking at the relative one-day performance for companies that beat expectations and for companies that missed. And what's in here, so the companies that beat expectations had a hell of a day, but what's interesting is a lot of these companies were the companies that had gotten the crap kicked out of them. McDonald's is a great example of this.
Yeah. So you have a lot of stocks that just like nobody was very excited about their numbers.
Yes.
And then they came out, they beat on earnings, they beat on sales, and the stocks were rewarded that day at a rate that we haven't seen in years.
So companies that had depressed expectations, that had been left for dead, that nobody cared about, versus the Microsofts of the world that, oh no, Azure only grew at 29% versus 30%, and the stock gapped out immediately 7% over whatever it was. So that trigger, it happened because it happened. It's, you know, you can come up with reasons that are reasonable, but it happened. Okay. I want to look at some of the Mag 7 earnings stuff just to remind you, not you, Josh, but you, the viewer, where things stand and how these giant companies are performing. So Alex Morris tweeted, Meta's trailing 12-month revenues per average employee skyrocketing. Their earnings were up 20-something%. I'm sorry, their revenue was up 20-something%. Their expenses were only up 7%. Not quite an all-time high for the advertising revenue, but right about there. Chart off for a second, John, please. And the point that I wanted to make earlier that I forgot to is that a lot of these companies already right-sized the ship. There was a lot of, and I know we're talking about corporate America, so it's not exactly the same thing, but 2022, 2023 was the year to shed expenses. So I don't know how quick companies are going to be to then do like another round of layoffs. I think we did that already.
Well, if revenue falls, they will do another round, but that's not the case right now. They're still growing, and business is great, and that's why you're getting these outsized earnings, year-over-year earnings gains, because to your point, they acted as though there was a recession in 2022.
There was for them.
And 2023. And I guess for them, there wasn't truly an economic recession, but there was definitely a growth scare. And everyone in Silicon Valley all at once said, okay, the rate at which we hired during the pandemic was absurd. We have a lot of employees who are here to have brunch and film TikToks and take meaningless meetings about nothing. And we're going to get rid of that layer of employees, and we might even cut a little bit deeper in some areas. And the end result is, so long as business didn't fall off a cliff, all of these companies became way more profitable than we thought that they would be. And so that surprise is reflected in huge rallies for their share prices in 2023 and the first half of 24. If we don't have the economy fall off a cliff, Meta doesn't need to have another round of layoffs, because to your point, they've already done it. But in an economic downturn, I would say they're probably not done. And that's probably a story that extends across all of these companies.
So two things are true. Just because the Mag 7 stocks were working doesn't mean that everything is amazing in the economy. Just because the Dow dropped 1,000 points yesterday, or 2 days ago, that also doesn't mean that we're going through a recession. Like the stock market doesn't tell the truth all the time. Sticking with some of these giant tech companies, Azure revenue run rate, I mean, you know, up and to the right, just incredible growth. Apple services revenue, new all-time record. Apple gross margin, new all-time record.
Yeah, I don't know what else could you possibly want. all of these fundamental. Forget about the stock price. All the fundamentals of these companies look incredible.
Last one, Apple. I'm sorry, AWS at Amazon. Free cash flow trailing 12 months going up and to the right. AWS all-time high. Not quite as fast a growth as it used to be, but still up 19% year over year for AWS. Josh, here's an amazing chart that I've never seen from Daily Chartbook. Compared to the early 2000s, there's no bubble in tech employment. Look at this. So we're looking at tech share of U.S. employment. And for those who are listening, this got over 5% in the peak in 2000. And today, by the way, you see that right sizing, Josh. You see the layoffs in 2022. Today, it's 4%.
Yeah, one of the things that happened during that tech bubble in the 90s was anyone who wanted to go public could go public. We just had like thousands of companies that had a lot of money and they needed to hire people. If you raised equity via IPO in 1998, 1999, you needed to go out and hire people. And a lot of people just got these fake jobs at fake companies. They didn't know it at the time. They were being compensated with stock. And that's how you got that huge boom in, what was it, over 5% of American workers were working for tech companies? Okay. A, they weren't really working, and B, those weren't really companies. This is obviously different than that. We have a higher quality tech sector, and we might have had a lot of SPACs, but we really have not had a ton of companies come public and just start throwing stock around. There was a Simpsons episode where Homer got a job at a tech company, I think, in 1999. Or maybe it aired in 2000, but they wrote it in 1999. And he goes into the men's room and pulls the toilet paper dispenser, and it's a roll of stock certificates. Like that's how they're compensating employees. So that was a sign of the times. We did not have that.
So
what are these advertising charts?
We already did that, but just to put a bow on this, I say all this to say that I love a re-rating of the best companies in the world because of an unwind of excessive leverage and margin and things that have nothing to do with the fundamentals of these companies. Now, if you tell me that that's going to lead to a permanent re-rating, the AI bubble burst, sorry, I don't think that's the case. I just don't. Maybe this looks very foolish in a couple of months, but I don't believe that to be the case.
If organic cloud computing growth at Microsoft, Amazon, and Alphabet is now going to be closer to 15% than 20%.
That's different.
Then the re-rating is justified.
Yeah.
And it honestly doesn't make sense that you can have those three players plus, or I'll throw in Oracle, all growing at 25% a year or even 20% a year. It seems impossible.
Counterpoint.
I mean, go ahead.
Jassy said on the Amazon call, I hope I'm getting this right, that like only 9% of companies have migrated to the cloud. There's still a long runway ahead.
That could be. It seems like there's still a lot of capacity being built to chase that demand by a lot of players. We're not in the situation where it's AT&T versus Verizon. So it's not matured. I agree with that, but I don't know if 20% is possible anymore. If AWS can't do it and Azure can't do it, like now, why do we think that's going to reaccelerate in a year?
AOI.
So, well, maybe. All right, we have to cover this yen carry trade thing. This is one of the dumbest reasons for people to be nervous about the market that I can come up with. I know you added it to your reasons to sell chart, and I was glad to see you do that. Are there things that haven't been said in the media or that are worth us delving into here, do you think?
I guess what I would say, though, is nobody gives a shit about the reason. Like, that's the thing. I certainly don't. Like, nobody that texted me yesterday asked me about the yen. They asked me about the stock market.
Can I ask you a question? If I landed from another planet today, and I looked at the stock market and I said, explain to me what the yen carry trade is and why it affected the stock market, how would you explain it? Let's say I'm an alien. I understand English, but I don't know anything. What would you say?
I would say that there are different borrowing costs for different currencies. And you could borrow in this currency and then buy in that currency, or borrow here and invest here. And one of the currencies was really cheap to borrow from, and people were doing that for years and years and years, and it worked for a long time. And then one night, that thing unwound.
Okay. So retail investors in Japan are probably not the cause of this.
No, it's hedge funds.
This is hedge funds who are... This is a carry trade. It's a very well-established thing that banks are facilitating.
Buffett did this. When he bought his Japanese stocks, he borrowed in yen.
He sold bonds denominated in yen, correct. Okay, so you can borrow cheaply in yen, and you could use that money to buy assets in the United States.
It's a free piggy bank.
Right, so it's great until it gets thrown in reverse all at once. So the Bank of Japan did a quarter basis point hike, a quarter point hike in interest rates at the same time that here in the U.S. we know the next move is lower, and as a result, that differential is what caused some leverage unwind.
Hey, you
got
to put up more money. It's a margin call. So do you think the Bank of Japan knew this was going to happen? They must have, right?
I'm sure it was on their list of potential things that could happen.
Like, do you think they're like, oh shit, fuck, this?
No. And one of the things I did like a 1 minute hit on CNBC just to talk about the Berkshire Apple thing. But Scott asked me about this. I just said, if you're not leveraged, why would you act like you're leveraged?
Great point.
So like the people who were selling yesterday, for the most part,
they had to.
And that's fine. Those are professionals. Yeah. This is what they do for a living. They buy and sell their hedge funds. If you're not one of them, what the fuck are you doing?
Right.
Like why are you freaking out? Why are you going to start selling? So I never understood this idea. The only thing I could come up with is people are getting like macro commentary from people that are treating regular investors as though they're institutions in the way they speak to them. Like, oh, this is blowing up. You better do something. Who, me? I need to do something? I'm not doing any yen carry trade shit. I'm just a humble shoemaker.
Yeah. No, I think the thing is that when people see this, they think, is the, I'm using air quotes, bubble about to pop? Do I need to get out? It has nothing to do with the macro. It's just they get scared. Like,
you know what I saw that disappointed me yesterday? James McIntosh did a piece comparing yesterday to 1987, 1998, and 2008. Why?
I think the 87 and 98 comparisons are fair.
You do?
Yeah.
I mean, he concludes with this isn't that. Okay, great. So he cleared his throat for 3,000 words, and then he's like, yeah, but don't worry about it. I honestly don't understand why you think this is an apt comparison to 1998. In what way?
Because that was a currency blow. It's not like too dissimilar. It was
crisis. There's no crisis in the yen. It isn't that.
Yeah.
It's literally not that. In 1998, the Russian ruble went to zero. There were people that were stuccoing the outside of their homes with worthless rubles.
Listen, I'm just saying we don't have a million comparisons. It's not totally ridiculous. The 87 one, we know what happened. There was leverage unwind and markets crashing.
Okay. Can I give you a better comparison?
Sure.
Okay. September 2014, the yuan refix in China. Mm-hmm. The S&P 500 fell, believe it or not, 20%. And I think 16% of that 20, or maybe it was 16%. I forget the exact number, but it was as close to a bear market as a currency has caused.
So that morning or that afternoon, I had lunch. I think it was August 24th. I think that was the date. I had lunch with Barry and Jason Zweig, and I was like scratching myself. So I was like on my phone the whole time. I was like, guys, I gotta go. What are we doing here?
Yeah. Because they're right. So because they're kibitzing and the world's falling apart. Okay, but that was over a very minor, mild adjustment to the yuan, but it threw a lot of things into, like, it threw a monkey wrench into a lot of things that were related to currencies and borrowing and leverage and whatever. That's what this is. It's not. Why are we having 1987 comparisons?
Well, the Nikkei, it was the biggest drop of the Nikkei since 1987, literally. So it's not
I understand.
Ridiculous.
No, I understand. The Nikkei has now recovered what percentage of that drop as of right now? Had a huge comeback overnight.
It's up 10% today. I mean, it
fell 12 and it regained 10. It's still down.
It left a mark. You could
for sure.
But best day since October 2008. Now I'm not ready to say it's over, right? Like we'll see. I hope that was it, but we'll see. I don't know.
Oh no, I wouldn't say it's over, but I would also say, imagine the ridiculousness of thinking that you need to do something because a carry trade blew up that affects mostly global macro hedge funds.
The only thing you needed to do yesterday, if you did anything at all, was panic buy. And with that, Let's look at some context here. So, ChartKit made this for Ben. 94%, so every year basically, has a drawdown of 5% or more. 2/3 of all years has a drawdown of 10% or more. We didn't. I don't even think we got there. Did we get to 10%? I don't even think so.
No, the S&P was in an 8% drawdown or something.
Okay.
So
the reason doesn't matter. I mean, I know it always matters, but it doesn't matter.
Matters at the time, but not in hindsight.
It matters at the time. This next chart from Charter is really eye candy. It shows the days when the Nikkei moved less than 1%, rose or fell more than 1%, and then there's a few monster outliers. So for those who are listening, they've got dots for every day going back to 1985. And the dot yesterday on August 5th was, as we just mentioned,
That's a crazy move.
The second worst day of the last almost 40 years. So listen, it did the thing. What was so interesting about the open in the United States stock market yesterday was we had this massive VIX spike over 60, which doesn't happen very often. You had that in the GFC, you had that in COVID, but what's different now versus then is those VIX spikes happened within the context of a broader deterioration in stock prices. We were already in a massive drawdown, and here you had a VIX spike over 60. We were down 9%. Very, very unusual.
I had a lot of green stocks yesterday, like on my screen.
Yeah.
Like we talked about Keurig Dr. Pepper the other day here. We did make the case. I'm not long the stock at the moment, but like that was green. I had utilities green. There were 26 names on the best list, the best stocks in the market list that Sean and I keep. There are 26 names on there. Coca-Cola's on there. Duke, Consolidated Edison.
Consolidated Edison. I've never heard of
26 stocks out of the S&P 500. That's 5% of the index is at 52-week high.
Yeah.
So you had a VIX at fucking 60.
It was weird. It was very weird.
And you have all these green stocks.
So anyway, when people panic sell, I'm sorry, you have to panic buy. If the VIX is over 60, you have to buy something.
Dude,
I don't care what. You have to buy.
I didn't buy anything yesterday, did you? I did. I did the one thing. I bought the inverse VIX ETF right at the open. As soon as I saw VIX 55, I said, "Okay, this is the dumbest thing I've ever seen."
You're gonna
be
mad at me. Sunday night, I bought Bitcoin and ETH during the puke. It's the only thing I could buy. Although I did think about buying.
Did they recover? I won't be mad at you. Did they recover?
Yeah, a little bit. But I thought about buying Nvidia, but on Robinhood, but it was just so early. And the other thing is, I need access to margin. I didn't have money in my account, so I had nothing to buy. I was fully invested.
Dude, respectfully, Bitcoin and ETH acted like garbage.
When respectfully, I don't care. Yeah, no, I know.
Episode. No, I'm just respectfully to the people watching the show. I don't really understand what it's like 2x Nasdaq. Like they don't hedge shit.
I don't think anybody actually says they're a hedge. Like nobody actually seriously says they're a hedge. They're not a hedge.
When they're green, people say, "Look, it's hedging." I don't know.
Well, you could ignore those people.
I was disappointed that Bitcoin didn't act more gold-like because this is not an economic meltdown; it's a carry trade blowing up. Why wouldn't Bitcoin
with
work?
Bitcoin specifically, there was allegations that one of the largest crypto players was dumping, and people really don't know why. So that was sort of a separate but related event. Anyway,
I did the inverse VIX trade. I didn't make that much money on it, so I closed it out at the wrong time. But I didn't buy. I should have bought. Uber was in the 50s. I should have bought some Starbucks. I should have been more active personally than I was. I was just busy doing other shit.
And it was over very fast. It was over very fast. And maybe it's not over. We'll see. There's a strong balance. But my point is, when the VIX is spiking like that, you got to put some money to work. So we got a few charts from Todd Sohn. Check this out. We're looking at the S&P 500 forward 6-month return versus various VIX levels. And it's not always up and to the right, but for the most part it is. So he then breaks it down into deciles, readings for the VIX, and forward 6-month returns. And the 10th decile, which is a VIX over 30, 6 months out, returns are incredibly strong for stocks. And listen, this is it. You buy panic. Now, it's a little bit weird, again, because, man, buy panic. We're only down 9%. Okay.
I was going to say, this is not going to work the way that historically it's worked because the market didn't come down that much.
It's weird.
So I would take that chart with a grain of salt. I like the visualization that you want to buy VIX. first of all, Todd's point, my point, your point are all
panic.
the right point.
Buy panic.
VIX 60, shut
Buy
the
something.
fuck up and buy something.
Yeah.
Like the most obvious thing to do.
That neither of us did. Well, I bought the coins.
That I didn't have time to do.
Okay. Also, inverse ETF volume was the highest since the SVB failure. So there was legitimate fear yesterday. Now, no offense, what sort of donkey was buying inverse ETFs at the open yesterday?
Inverse VIX ETF, me.
Oh.
Inverse VIX ETF, not inverse stock ETF.
Yeah. Okay.
Oh, were there people selling on the open? Yes, that's how it opens down.
Yeah.
900 points.
No, but buying,
because there are people selling.
Take the fix out of it. Buying like inverse NVIDIA
What,
at the
SDS?
open or whatever whatever you like. I don't know.
Yeah, well, there are people that do that because they want to stay long a position, but they want to hedge against the market getting much worse. I don't do that.
When you gap down 4%, that's a tough buy.
Listen, I don't hedge positions. If I am trying to manage my risk, I limit the size of my positions or I use cash. I'm not out there being like, well, I don't want to sell this, so let me trade this other instrument that should offset the. It's just not. There's nothing wrong with that. I don't do that.
Meanwhile, you couldn't even get into Schwab anyway.
Yeah. So right.
So,
Maybe that's why it was so weird. Put this back up though. Inverse ETF volume. So the point that Todd is making is it's shy of prior bearish extremes, but it is a notable spike for
it's
inverse
usually
ETF.
things that you see around bottoms. But again, the difference is that this time it's hard to say we're at a bottom when you're down 8-9%.
Yeah, I don't envision this one resolving with a V-shaped recovery in the month of August. I think what we're going through right now is fundamental, and it's not just the yen carry trade blowing up. There are some real concerns about growth, and there are some real concerns about the Fed maybe being a little bit too late. And I could be wrong.
Let me ask you this: we know how the stock market will react if we get more weak data. It'll puke. How would the stock market react if we get a really nice rebound in data? And we say, oh, those July numbers were due to weather or whatever the case may be.
Yeah, it's possible. It's happened before. There've been a million head fakes. So I would never say, nope, this is it. This is my opinion and it can't change. My opinion right now is that we really are seeing, I hate when people say the consumer. We are seeing the bottom half of consumers make material changes in their ongoing spending. We are seeing corporations that cater to that consumer desperately trying new things to bring them back to spending. And now we're seeing the unemployment data surprise repeatedly to the downside.
Yeah.
And it's just hard for me to get to a V-shaped recovery in my head for stocks. We'll see.
Yeah,
we'll see what happens. Buffett sold half his stake in Apple. I think my personal opinion is when that news hit over the weekend, that was the straw that broke the Nasdaq's back coming into Monday morning.
Yes.
It made everything worse.
Absent the yen, Apple still would have had a monster gap down.
Yeah, I think so. Berkshire sold $75.5 billion worth of stocks, which boosted their cash and equivalents to a record $276.9 billion. Now, it's important for me to say it's a record cash pile, but as a percentage of Berkshire's market cap, it's about 34%. The average that Berkshire holds in cash is like 25%.
John.
Okay, thank you. Oh, it's 31%. Okay, so it's elevated relative to history in terms of like how much cash they have, but relative to market cap, and this is quarterly, shout to Chart Kid,
and
it's not some insane number.
No.
It's just at the higher end of what's been typical. And people, look, I get it. It's juicy. Journalists want to write about it. People want to talk about it. And maybe their cash balance goes even higher. But the market cap of Berkshire is near an all-time high. The stock has gone from 300 to 430 in the last 6 months.
Dude, you know what's also at an all-time high? Berkshire's liabilities.
Yeah, which is what they're funding with all this cash. So I think people need to relax. Now, that being said, this is their biggest stock position. They've been in it for over 10 years, and they just whacked out half of it. And Apple is trading 30 times forward earnings. So there's no way Berkshire sees as much potential upside as they did when they started buying it 12 times earnings.
There's not. So I have two things to say on that. Number one, we spoke, I can't remember when, about Apple's price to sales ratio was trading between 3 and 4 times forever. And then it just went vertical into a different regime. And guess what? Buffett, well, whatever, his lieutenants, they nailed it. They absolutely nailed it. One of the best investments of all time. And it's still, throw this Alex Morris chart on, it's still 30% of their portfolio. So to say anything that Buffett is even remotely bearish on Apple, fine, he doesn't see the same upside, is a joke. It's a third of their portfolio. 1/3.
That's assuming they're not spending this quarter selling the way that they were last quarter. Who would
Fair.
know?
Okay, fine. But I'll give you one more thing. John Huber had a great tweet about what Buffett can do with his cash. He said, there are probably only 50 stocks in the U.S. that Berkshire can buy that will make a difference. So think about a $600 billion portfolio. So a 5% position is $30 billion. This limits his universe to $300 billion market caps at a 10% ownership. Guess what? There are only 27 stocks in the U.S. this size. So if you go to a 20% ownership, and that opens it up to an additional 50 or so, but it's difficult to buy that much, and this is only for 5% portfolio position. All right, you get the point. Chart off. There's only 27 stocks that he could buy legitimately that would move the needle. So, okay, maybe he is doing some buying right now. We don't know. We'll find out next quarter.
Yeah, one of the more likely things in recent years, what we've seen is he picks an industry and he buys, a whole bunch of the best players. So we have seen them operate that way. I don't know if that's out of necessity or not, but when they wanted to put on that Japanese trading house bet, they didn't pick one Japanese trading house. They bought 5 of them. They took really big stakes. We've seen him do that with the airlines. So he doesn't necessarily have to find the one company that's big enough for him to invest in, per se. If there's a view that he wants to express, he absolutely could express that over multiple companies. My best guess, if you ask me what he's about to do, my best guess is it'll have something to do with home remodeling and home renovation. Because if rates are coming down and mortgage rates are falling, and we're going to get this restart to existing home sales, and people are going to refi, and we're just going to see more activity in real estate. Combine that with the demographic tailwind that is the millennials in their peak home buying and family formation years, and just the overall shortage in housing that we have. I think Buffett's going to want to take advantage of that situation, and I would not fall out of my chair if we woke up one day and saw him with a giant position at Home Depot or Lowe's or Sherwin-Williams.
Okay, so I'm so glad you mentioned that. So I'm looking at the market caps of some of these companies. Like, what would be a Buffett name? Like, oh, maybe Dollar General. That company's been around. There's a long legacy and it's in trouble. Maybe he would buy Dollar General. Guess what? Dollar General's $27 billion. It wouldn't even move the needle from if you bought the entire company. So you mentioned Sherwin-Williams. $86 billion. He can't buy it. Unless he wants to buy the whole thing, he can't buy it. What about a company?
But my point is he can buy 7 of them. He could buy 3 of them. We've seen this. Warren Buffett,
that's not like a core Berkshire type of business.
I disagree with you. Warren Buffett spent the year 2002 and 2003 as the Fed had cut rates substantially in the wake of the dot-com crash and 9/11. He spent those 2 years accumulating Mohawk and companies that make carpeting and aluminum siding and paint companies and home builders. And those purchases came about a year before we had this massive housing boom in 2003, 4, 5, 6. It was it was the biggest economic trend of the decade. And Buffett didn't buy one; he bought like 6 or 7 of these things.
All right, time to buy Sherwin-Williams. I own it.
So I feel like that's probably the next trade he wants to express. Rates falling combined with not enough houses is a huge opportunity. It's a huge opportunity. I don't know the right way to express it. Maybe there's a publicly traded mortgage company. I don't know.
I got it.
I wouldn't be surprised.
I got it. It's the yen.
He sold 90 million shares of Bank of America. So he's been blowing out of these banks. He's not as bullish on banks as he used to be. So he sold almost $4 billion worth of Bank of America. That's 7% of his total holdings. And that bank has gone up a lot, like Apple. He's done obviously really well there. And all the financials rallied this year. Bank of America had one of the bigger rallies. So he took profits there too. And no buys to speak of. So
okay, let's talk about YouTube. So this thing that I subscribe to, I saw Lindsay tweet it. Dan Frommer at The New Consumer did a really good post on why YouTube is television. As we know, it is the most watched streaming service in the U.S. 40% of all streaming is on YouTube. 10% of all streaming is on YouTube. It is bigger than Netflix and everything else, bigger than Amazon and Hulu and Disney and Tubi combined. More Americans say they choose YouTube over any other streaming service. So they now say 31%. That's up from 27% 2 years ago. And Netflix, interestingly, 21% down from 26% a couple of years ago. And this is part of the key, and maybe it helps to explain some of the success of this channel and what we're trying to do with our YouTube audience. YouTube and Netflix are both entertaining, but YouTube makes 2x the amount of users feel smarter. So they ask, like, how do you feel? Do you feel happy? Do you feel relaxed? And it's about the same between YouTube and Netflix. But when you get to smarter, only 15% of respondents say Netflix makes them smarter. On YouTube, it's 31%. So it shows like this and people figuring out how to fix dishwashers and whatever. And then lastly, this blew my face. Mr. Beast generated $223 million in revenue last year with 700 projected for this year. Oh my God. And they asked the percentage of Gen Z YouTube viewers, like, do they know Grey's Anatomy? Do they know Squid Game? Do they know Stranger Things? And more Gen Zers know Mr. Beast than Seinfeld and everything else.
This might be a generational thing. I don't get this guy's deal or like why people are so entertained by this. It's like locking people in a room with money and they have to kill each other and only one of them can walk out with them. Who is this entertaining?
I don't know,
It's
but
so
Mr. Beast aside, like YouTube is becoming indistinguishable from just television.
Yeah. All right. Well, so there are sophisticated things on YouTube like us, and there's dopey shit on YouTube, and there's stuff for 5-year-olds. There's something for everyone. So that's number one. And of course, this is like Netflix would like to do that. It's just really hard to do that and do it well. Even Amazon, which now has hired this Mr. Beast person and his entire team, they're now trying to produce a reality show, like a game show, a Mr. Beast game show, which by all accounts, they haven't hired any television producers. He basically brought his YouTube team to help do this. Maybe it'll work, maybe it won't. But I think that we used to have basically 3 networks or 4 networks in this country, plus HBO. We're going to go right back there. And almost everything is going to end up being a channel on YouTube or on Amazon Prime.
It already is. Like on Prime, like I have my Paramount, I have all my subscriptions. Prime is like one of the hubs.
Yeah. So YouTube's one of the best businesses in the world. If it were a standalone company, if Alphabet had ever spun it out, it would have a massive market cap and a completely different valuation probably than what it gets for being inside of Alphabet. It's not quite as pristine a model as maybe I've made people think in the past, like in terms of like, oh, they have no cost. People just upload their content. They do have costs. They have compute costs. It costs a lot of money to be YouTube, maybe more than it costs to be Netflix.
It's probably YouTube is probably worth more than Netflix. Netflix is $260. Let's say YouTube is what, $300-ish?
Yeah. It costs a lot to run this business is the point, and that's why there aren't 3 YouTubes. There's a barrier of entry here. Google is paying for a lot of compute and paying for a lot of data and a lot of storage, and it's not that simple of a business to run just because they don't have the risk that a studio takes to create content. They still have a lot of cost in this model, but it's working, and yeah, I do think it's what people under the age of 20 consider to be TV. They don't distinguish between YouTube and Netflix. They just know they like it or they don't. And that's really where it is right now.
Okay, so I'm going to make the case, not for any stock ETF in particular. I'm going to make the case, a reminder of what risk management is. And risk management is not a formula. It's a feeling. And sometimes you have the feelings and sometimes you don't. Yesterday, you had the feelings. Everybody has their own line, which they shall not cross. And you only really know where that is when you step a little bit over the line, and you discover that on days like yesterday. Yesterday is a great barometer for your own risk management. So what I would say to you is, if you woke up yesterday and said, holy shit, or you felt any sort of anxiety or negative emotion, but not just anxiety, because we all felt it, but to the point where you felt like you had to do something to make yourself feel better, well, you're taking too much risk, clearly. On the flip side, if you woke up yesterday cool as a cucumber, you could probably take more risk, assuming that you're not fully invested. And I think yesterday is just such a great reminder of what your own risk tolerance actually is.
It's a good point. It's not a formula. It's feel, and it changes for each person over time. And people learn, and their risk tolerance changes because they've been through more. I think that's a really good point. If only there was some one-size-fits-all thing that you could say, like, okay, here's a formula for risk management. This works for everyone. It really doesn't.
So anyway, buy more Starbucks.
What was my risk? So what was my feel at the open yesterday? Do you remember? What was the first thing I slacked to you and Ben yesterday?
You were kind of quiet on Slack yesterday. What was
my first? Oh, here's what I said to you.
This is the fucking dumbest thing ever?
Yeah.
Is that what you said?
I said SVXY looks like free money. Short-term VIX ETF. I posted a chart, and then I said VIX just went from 13 to 55 in a week. It's so fucking dumb.
Yeah.
So that was so my attitude yesterday was really not the way that it's been a lot of times when we have these horrible mornings. My attitude yesterday is, oh, what are these idiots doing now? And I should have acted on it more than I did. Mystery chart for you. Let's get that up, John. Okay. I'm going to show this to you on two different time frames, and I'm telling you that it's a ratio chart.
I'm bullish.
Or I'm telling you that, well, I know I'm definitely bullish, but it's not a ratio chart. It's a spread chart. Maybe that's the same thing. Okay. What do you think this is?
Are you fucking kidding me?
Okay.
What do I think this is?
It's fixed in. I didn't take the prices off. It's fixed income. It's not stocks.
Oh, is it the 2s 10s?
Attaboy. Okay. All right. Let's do the reveal with the other. So this is I'm showing you 1 year. I mean, this is clearly a situation where bonds are going higher, yields are going lower at the short end. And the important thing that I want people to take away from this is a 3-year. We're uninverting. Isn't that what we wanted? See the 0% line? We're about to cross above that 0% line and have an uninverted 2s 10s.
And that's when the recession starts.
Well, I'm just saying, like, that's what this is. If you believe what the Fed is saying, which is that this is normalization, that's kind of what you should want. You should want a steepening yield curve and an uninversion, and that's what we're getting.
If there was like a real growth scare that people are like, uh-oh, like we're going into a recession, the 10-year would not be bouncing as it is. It would not be 3.9. It would be much lower.
Yeah, I think that's right. It would be rapidly heading toward 2.5.
Yeah.
To capture the idea that the Fed's going to have to go to 0 again.
Yes.
So none of that is taking place. We have a nicely uninverting yield curve, which is what you should want to see. All right, that's it from us, everybody. Thank you so much for watching. Thanks for people who made the debut live. We appreciate you. Make sure to listen to Animal Spirits with Michael and Ben tomorrow morning and every Wednesday morning as soon as you wake up. We've asked the Compound on YouTube on Thursday with Duncan and Ben. An all-new Compound and Friends Friday.
Who's on?
And Jill is back with an all-new Jill on Money this Saturday. Who's on Thursday?
Yeah.
This might be our best show of the year, not to brag. But we'll put a pin in that. We'll let people guess.
Will there be charts? Will there be charts?
There will definitely be charts. All right, good night, guys. Thank you.